Lee's the winner.
Where Lee's?
Are you talking about next year? Where do you want to go next year?
Yeah, I wasn't gonna bring that back up, but Lee won 2025. There's no prize. Congrats.
Yep.
What about 2026?
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt here with Lee.
Good morning.
And John.
Good morning.
And today we've got a fun episode planned. Going to answer a listener question that they posted on one of the last videos that we put out. Also looking back at 2025, so last year's predictions, kind of what each of us thought might take place in 2025 and how accurate or incorrect we were. And then we're going to start talking about 2026. Which might not mean much once you see what our 2025 predictions were. But
we're pretty close. We're pretty good.
Yeah, so real quick, so to start, let's start with the question that we got. So we got a listener question, a question about RMDs. If someone owns several IRAs, do the RMDs have to come from each IRA proportionally, or can the total amount be taken from one IRA? So this is a great question. Something that we run into a lot, in terms of clients wanting to clarify. So the rules are fairly simple and straightforward, but they are different for different types of accounts. So for IRAs specifically, to answer the listener question, you can take the RMD, required RMD from any IRA, and you can take it all out of one, you can take it out of multiple, it does not matter, okay? So that's pretty simple. Oftentimes clients will take it out of one because it's maybe simpler, or they have an account that's, more conservative or more aggressive, and it makes sense to take it out of one particular IRA in a given year. So
the only caveat is the beneficiary IRA, which I'm sure you were going to get to.
Yeah, well, actually wasn't. No, I actually wasn't going to get into that. I was going to get into 401ks, 403bs and stuff. But
just to add to that, beneficiary IRAs are different. So if you have a beneficiary IRA and you have 4 other IRAs, the Benny IRA has its own thing. Schedule.
Correct. Yeah. That said, a lot of investors roll money out of 401ks when they get to retirement. Mm-hmm. They move it into an IRA because they want to manage it themselves, or they're working with an advisor, whatever the case may be. But not everybody. There are plenty of people out there that still keep assets in 401ks. 401ks are different. You have to take each RMD from that specific account. You can't take a 401k RMD and pull it from your IRA. That's not going to satisfy the 401k RMD. 403bs are similar to IRAs, but you have to take it from a 403b. So if you have 2 403bs, you can take the cumulative from one. So it's similar to kind of IRAs. 457s must be they're like 401ks. You have to take it from each individual account. So the most common question is the IRAs, because again, most people roll it out. And so that's easy. You have more flexibility there, but just do keep in mind, if you have a 457, 403B or 401k, you do need to take it out of there. You can't try to gross up and take withdrawals from your IRAs to satisfy those accounts. So,
correct.
Yeah.
Good question.
Great question.
Anything to tie a bow on that?
I think the bow is tied.
That is okay. All right. So looking back at last year's episode that we recorded right around this time, the end of 2024, we're looking ahead to 2025, and we had some predictions about just what was going to happen, where the market was going to be. And so, we talked about, we kind of were in full alignment with the Trump tax cuts going to get extended, and made permanent, which ended up happening. That was a very positive thing for the markets. John's prediction for the S&P 500 at the end of 2025 was 6,500. Mine was 6,400. I can't believe I was the most.
You were more pessimistic than John.
Yeah. Lee's was 6,800. So let's look at where we're at today. The S&P is at 6,800. So.
But we have 2 weeks left, so this is not over yet.
Yeah, if the odds continue, this is the last time Lee will ever be that accurate.
Correct.
So, yeah.
But we're all within a margin of error, which is pretty amazing.
We all saw,
20%.
Well, 5%. We're good.
Let me see where the market was at this time last year. What was it trading at? I say the market, the S&P.
S&P.
So if we look at the end of 2024, It was like right at 5,900.
So we've added 1,000 points.
Yeah. So we all saw, like a 7 to 12% return. We thought it was going to be a decent year. We saw some volatility. One thing Lee mentioned, I just have to mention this since you were the most accurate, but you said you thought most of the returns would come in the first half of the year. We had a 20% pullback, and then the market's ripped ahead. So most of it's kind of come in the middle to latter half. All of that said, it's kind of fun to talk about, but predictions are completely worthless. And it's fun to look back and see, like, hey, how close was I? But don't ever take anything we say. Don't ever take really anything anyone says. I don't care.
As far as predictions.
In terms of, like, predictions and saying this is where the market will be at this point in time. Over the long term, I think the longer out you go, I think the more serious you can kind of take expectations and predictions of, like, this is what we see over the longer term. But in a 1 year time frame, it's just it's kind of like flipping a coin. But
it's hard. And if you look at sitting here a year ago, kind of thinking about what the next year is going to hold, we had an idea, but man, it seems like years ago. But I mean, we entered the year, talking about tariffs. We talked about rate cuts. How many would there be? There have been 4? Have there been 4 this year?
There have been 3 in a row. I think there's been 4 or 5. I mean, maybe 4 is all there is.
I was thinking it was 100 basis points. But regardless, we did get rate cuts.
At least 4.
Which was nice. Yeah. We've talked about
I think it was 3.
3?
Yeah.
Okay.
Oh, just 3? It's 3 in a row. So
we've talked about the Trump tax cuts that were made permanent. Here's an interesting question, and I'd love to get your take on this. Has the economy gotten better? And of course, then is the market overvalued? But is the economy, in your opinion, better now than it was a year ago? I don't know if I would personally say it's better. I think it is still good, but I don't know if it's necessarily better.
I think there's a lot of things that are fine and look good, and then I think the labor market kind of scares me a little bit. I mean, again, we seem to be just moving right along. We had some numbers revised, or it
was a surprise this morning.
Yeah, we missed we had the government shutdown, so we missed numbers for a month, and they're kind of catching up now. And we had a little bit of unemployment news that came out today that wasn't necessarily great, but overall, and I also think, and I've been hearing this a lot on the political side, where the midterm elections, which come in a year from now, right? The concern for the party that's holding, right now, the Republicans, is that although we're touting a good economy and all that stuff, the younger folks are still suffering, right? So it's hard to keep touting a great economy, everything's going well, when rents are high, it's hard to get in a house, debts are high, So, I mean, there's 2 sides of the coin. I think things are going in the right direction. I do. I feel good about it, but I also think it's not there yet, not even close to where it needs to be, the economy.
Yeah.
So that's my opinion.
I think things are still good. I think, everybody points to the Christmas season, retail sales. I think retail sales are coming in great. I think the more we get into this economy, the more, and I think Matt mentioned it last week, was this K economy, and I think there's some real truth to that. I think that we have 2 economies out here. We have an economy that the upper middle and the upper class are doing well, and then you got another economy that lower middle and lower class. From an economic perspective, I mean, they're struggling.
We need to fix that, right?
Yeah.
And that's hard. Anyway.
Yeah, I mean, you can say, the economy can be good or decent, right? And that can mean different things at different points in time. Sometimes that's going to be pretty widespread, where that's kind of applicable for everybody. Sometimes that's going to mean there's certain parts of the economy, certain industries, certain people doing better than others. Both can still be true, though, where it's like, generally speaking, the economy is like okay.
Yeah.
I think you just like the stock market, it's like you don't want, the economy gets too heated for too long. You start thinking like, like how long is this sustainable? If it's just like, hey, everybody's crushing it year after year after year, So yeah, the reality is people out there that are really tight spot, and there's people out there that are doing really well. If you own assets, you're probably doing okay. If you don't, things are tight, things are expensive, and so you've seen that with some of the elections across the country. The frustrations being kind of coming through in people's voting, and just looking for change. It's easy to say like, man, this is kind of crazy, from a historical perspective and some of these elections and who people are voting for and something. But I think people are just like, let's, to the point it's like, I'm fed up. I want to try something.
Sure.
Just try something different, even if it's not right. And I think we don't give enough time for change. We had a 180-degree change in the election of last year ago. And it takes time for that to get into the market, the things that are going. Even the tariffs that were so scary to some people are actually, there are signs of benefits to some of that. And so it takes time for all that stuff to get through the market. I think one of the things, like, there's two types of markets, in my opinion, when you talk about strength of an economy. People think immediately the stock market, right? The stock market shows great signs of strength and growth. AI stocks leading the way, and that is starting to spread out even more. We've talked about that on the show a lot. But the Mag 7, I think there's 5 stocks of that Mag 7 that are starting to show signs of weakness, which is just could be a little bit of a scary, thing for the market because they've been running the market, but the market is widening out. So maybe that'll, kind of wash itself out. Then there's the other economy. It's people putting food on the table for their kids.
Right.
And those are two different conversations, and they can both simultaneously they could go in different directions, both of those, which I think for the K economy, like you were talking about before, is happening. Even though the market continues to move up. So it's just a different way you look at it.
Yeah. One thing that I think, as we kind of transition into what do we think next year is going to look like, I think the economy will remain resilient. I think the labor market is one thing that could change that if it really started to spiral. From the stock market perspective, I think we're going to continue to see what we've seen the last few weeks with some of these large cap tech companies, the Mag 7, whatever you want to call them, that have led the market for years. I think we'll start to see those underperform relative to other parts of the market. Not that they'll do poorly, but I just don't think the pace they've been on is. We all know it's like, it doesn't mean they're gonna, all of a sudden crash and be a horrible company, but they might not keep compounding it 50% a year, right? And so I think we've started to see a little bit of a rotation out of, if you just look at the major indexes, the NASDAQ has kind of underperformed over the last few days, last week or two, relative to like the Dow or the Russell 2000.
Russell 2000 is actually starting to outperform, which is nice.
And that's not going to last forever. I wouldn't say, hey, buy the Russell and own it for 30 years, overweight, the S&P, but you do get periods of time, sometimes periods that can last for 1, 2, 3, 4 years where, parts of the market perform better. So that would be one of my predictions next year is that, if you look at the Mag 7, they're going to underperform relative to other areas of the market for the first time in a while. But I think overall, it'll be a pretty solid year in the market. I think if you're just buying the S&P 500, it's probably not going to be as good as it has been. But if you, if you have a broad allocation and maybe slightly underweight some of those large cap tech, I think you set yourself up for maybe a good opportunity to do well next year.
Here's my concerns for next year. Now, these are just every year, but this is the labor market we talked about. Because if you have a slowdown in hiring or firing or whatever, your consumer spending goes down, right? So that's duh. Inflation, and the reason why I think inflation could be a deal, we talked about the tariffs briefly, that we don't know exactly what's going to come from the tariffs, some positive, some negative. I do think with the immigration stuff happening and the tariffs, there is a concern of elevated inflation coming back in, right? We've kind of seen this inflation not be really a big, massive problem. We've been... the Fed, that's the big talk about the Fed all the time. But that could rear its ugly head again, potentially.
What's interesting is there's a lot of people, all these podcasts and articles I read. There's more than a few that have a very strong argument that's like tariffs are actually over the longer term deflationary.
No, I actually
there's-
kind of don't disagree with that. There's
So-
specific things that are
Right.
being hurt, in
Yeah.
that regard, but I totally agree. I also think geopolitical shocks. We've got, pressure in Taiwan from China. You've got still European powers are now starting to say, "Hey, Russia's for real. They're planning something bigger." I mean, those kind of things.
Yeah,
Obviously,
Venezuela now.
Venezuela has turned into a big deal.
Yeah.
I mean, those kind of things are always there, but they're always there, right? I mean, the positive side for the market, fiscal stimulus, Fed rate cuts, deregulation, all expected to boost growth, which I think are all great. AI investment still critical. And if we talked about this 3 months ago, that the S&P 500, the AI use on the S&P 500 was only 16%. This was 3 months ago. It's probably higher now. But just think about how much growth the AI still has in front of it in that regard. Tariff revenue. I think the tariff revenue is actually a good thing. It's a positive spin off of that, which we've not talked about much positive on tariffs, but there's some, And then optimistic forecast. Most economists are predicting a good market year. I think around 14% is the average S&P 500 prediction for 2026. And it's about a 30 to 40% risk of inflation if you look at all the experts on Wall Street, which again,
Of inflation or recession?
I'm sorry, of recession.
yeah.
Of recession.
I saw
I'm sorry, not inflation.
35% was kind of
I
the-
meant recession.
Yeah.
So that's still kind of a bullish trend, though,
Yeah.
and that sounds pretty darn good to me. So anyway,
Yeah.
My thoughts are, I think NASDAQ is the laggard next year. Nobody pays attention to the Dow. I think the Dow, the Russell 2000.
Yeah, you still.
I know.
Price
But
it
here's my.
points.
But
no, I
here's my
agree.
point.
Yeah.
I think the Dow, the Russell 2000, they will lead.
Yeah.
I think to Matt's point, the rotation has started.
International as well, potentially.
Yes. So I think that I think we have a very good year next year. I think another thing that we have not even mentioned is I think tax refunds in Q1 of next year will be huge.
Stimulus to the economy. Yep.
And we can't discount that.
They'll
I
be,
mean,
agree.
it's,
yeah, they'll be sizable, especially for the 65 and over.
yes.
You know,
Yeah.
in terms of like who's from a numbers perspective and
There will be a lot of spending in
Yeah.
the first half of the year. Now, I'm going to say it again. I think the majority of the gains next year are going to be in the first half of the year because I think
sell everything and buy in June.
well, I just think that I don't think it's going to necessarily go down. I
Yeah.
just think that
Yeah.
there's a lot of momentum building.
that
Yeah.
you think
For-
will carry us through the first half.
Yes.
Yeah, I think you're right. I love the stimulus stuff that's going to happen. The tax stuff is going to be a pretty big deal.
If you then, who knows when the rate cuts occur?
Sure. But we know in May there's a new Fed chairman, which will be on the side of what Trump wants to do, which will. So I did hear that the Fed was talking about how there may not be any rate cuts in 2026. They may, and I'm kind of chuckle because I remember in 2022 there was also supposed to be no rate hikes from the same Fed chairman, and now we're getting a new Fed chairman in May. And I think everything's get off the table of what to predict on that until we know that whole story.
I think overall, I think next year is a good year for the markets.
And then the stimulus will help all the things that we're a little bit worried about. The K-shaped recovery, like that could lift all boats, which I hope it does. So anyway, I agree with Lee. I think the market, the optimism is higher than it's been for a while. The wolf is always at the door, but we look like we're trending in the right direction.
Matt, apparently you made a comment a year ago when we were doing this that Zoe had prepared for us. It says we need a normal year. What's a normal year? I mean, and I'm kind of just throwing that out. What does a normal year?
I mean, S&P up 10%.
Yeah.
I mean,
And just
if you-
easy going,
just
like 1%
yeah.
a month.
Yeah,
Just
like- but no, just like have some volatility. The market the S&P ends up 10%.
Yeah.
Not, I don't know. And we've kind of had that. Hopefully it'll end up, unless something crazy happens these last 2 weeks, it'll end up better than that.
Yeah.
Sure.
Yeah.
But yeah, I think just a normal year in terms of like, we didn't need another 25 or 30% year. Not that I don't want it. It's just,
sure, sure.
last year was a really strong year, and every year you compound that on top of each other.
Yes.
It starts. That's when
Just
you
get
start getting a
overvalued.
little worried about.
Yeah.
Hey, there's
Yeah.
the pullback odds go up.
25 was almost a Goldilocks year because international was up, U.S. was up, large, mid, small was up.
Gold was up.
Gold
Everything was up.
Fixed
Bonds did well.
Bonds
Yep.
did well. So
Yep.
literally every area of the market, for the most part, is green.
Yep.
So anyway,
Which ends up being a pretty good year. What you were,
if you
honestly,
look at the
2025
year to
might be a
date,
year.
I know we're not at the end of the year, but
Yeah.
if you look at year to date, Dow's up 14, S&P's up 15, Nasdaq's up 18.
Yeah.
Right. Very, very good years.
Yep.
Not crazy,
right?
but very solid years. Especially considering the fairly sizable pullback we saw in April to end the year like that. So hey, I'll take it. For sure. So if we ended I know we're not to the end of the year, but if we ended the year right now where we're at 6,800,
Lee's the winner.
where Lee's,
are you talking about next year? Where do you want to go next year?
Yeah. I wasn't going to bring that back up, but Lee won 2025. There's no prize. Congrats. What about 2026? Where do you see the market? Pull out calculator. He's like 6,800 times 1.1.
7,900.
Okay, I love that. That's very optimistic, and I think we could get there. I'm going to be a little less
I was going to say
optimistic.
8,000 just to make it round, but I'm going to say 7,900 on the S&P.
I had in my head, I'm going to go
Mark the
below a little bit of the consensus and say around 7,500. So say 7,500.
Okay.
I wish you would have picked 74. I refuse to be the bearish one this year, or the most pessimistic. So I'm gonna say 75.50.
Or like
just so John's
price
low.
is right.
if we're all over, there's always somebody at the Price is Right who'll say $1.
Yeah, $1.
No,
It's gonna be
all
a
joking
one.
aside, I think we're at like 7,400. That would
Okay.
be my call.
I mean, that's what, 8%? Another 8-9%?
So take all of those numbers that you just heard us here and just forget.
Hey,
them,
I want to
'cause
say
they-
one thing on that. It was really funny. There's a chart that I have that I use sometimes and it's from 2024 prediction of the 2024 market, and it was the top 20 analysts on Wall Street. So every name that you could think of, top 20, all of them were wrong. In fact, some of the best ones, and about half of the analyst predictions were below, a negative return.
Yeah.
And the half that had a positive return, the highest positive return was about half of what the actual return was. And my point is, that's the 20 best analysts on Wall Street
know.
that have all the information from them, everything. So the point, to your point when you
It's
first
worthless.
said,
It's worthless.
it's worthless.
I don't even know why we're recording this episode.
it's fun to just kind of think. It's nice to know that we look at stuff and we do pay attention to numbers. We do pay attention to economic conditions and all that stuff. And it's good to make these predictions, but it is also.
But clients ask us these very questions
sure.
like, where do we think?
Oh, sure.
What is our
we
what
have
is
more
our
information
opinion?
than most people do out there, so it's good to be.
What's
it's just funny to watch.
No, but what's funny is we have a lot of information. We have access to a lot of research, and our guess is probably about as likely to be right as someone who has none of it.
Yes.
100%. You know, if you go like nowadays, we have all this chat stuff, GPT stuff, whatever, AI stuff. You can get all this information as an individual. You just type in your phone, where's the market going to go next year? And you can get everything told to you that we just said.
I mean,
right?
if you look
can
at
find
professional
anything.
analysts, almost every year, if you look at the average expectations, it's around 10% a year.
Yeah, exactly, which
it's
is what
like-
it's historically
which is
average
what,
forever.
so-
yeah, exactly.
Kind of
So
ironic.
it's funny.
It's
fun
yeah,
to do
but it's
it,
been
though.
it's been a good year. Congrats, Lee. You had
Thank you.
you had the crystal ball this time last year.
I can't win in fantasy football, but I can win in predicting the market.
Yeah, John and David are in the finals.
They
fantasy
are.
football.
It's a pretty big deal. I don't know if anybody's out there paying attention, but it's a pretty big deal.
No one.
Well, it's been a good year from the
Been fun.
market, in the business with our clients. We've met a lot of new people, working with a lot of great families here in Northwest Arkansas and all over the country. So we're incredibly blessed. That 2025 has been great. We have a lot of big things we're working on for 2026 that we're really excited about. A lot of momentum with the podcast and the data brief and the videos and the episodes and the content that we're putting out. So we're really excited about that as well. Going to try to continue to get better and better with some new things to come. So we appreciate you guys always tuning in, watching, listening, giving us a comment, a like. Be sure to share it on your social media platforms. We really appreciate that. And let us know if there's anything you ever want us to talk about. Shoot us an email or question, and we'd be happy to consider it for an episode. So we appreciate you guys. Hope you all have a very Merry Christmas, and we will see you next week.
Merry Christmas.
Merry Christmas.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.